In today's video, we are going to be breaking down the ETF, which is a BMO ETF, Global Consumer Staples, which is hedged to the Canadian dollar. It goes by STPL on the Canadian Stock Exchange. So let's get down, let's break this down, let's see how good it actually is. Because personally, if you're worried about certain countries or certain areas of the world not doing so well, this is actually a good way to hedge your bet on the stock market because, of course, it is a global ETF and it's hedged to the Canadian dollar. So let's get down, let's check this out. So the volume of this ETF is not huge. Its average volume is only 2,400 shares traded per day. So if you're looking to buy and sell this ETF maybe daily or weekly or whatever it may be, this is definitely not the ETF that I would be looking at if you were looking to be active like this. If you were looking to actually invest for maybe 6 months or maybe 1 year or more, this is definitely an okay ETF. But personally, 5+ years would be the goal here. Its expense ratio is a bit higher than some other ETFs. It is 0.35, which basically means that if you were to invest $100 into this ETF, for every $100, you would be spending about 35 cents per year to be able to have BMO basically manage your money. Its yield, if you're looking for dividends, is 2.16%, and it's been around since 2017. If we look at that 5-year chart, which is not a full 5 years, you're looking at 1, 2, 3, and 4, and roughly a half, maybe close to 5, but I don't think that's full 5 years just as of yet. We can see that there was a slight downturn up until 2019, which is when it basically blew up and did extremely well. And then, of course, we had the COVID disaster, and now it's recovering nicely. I think there's going to be a nice global recovery, which will allow this ETF to grow substantially over the next 1 to 2, maybe even 3 years. If we look at the dividends that it does pay, we can see that it does pay quarterly dividends, which is something that is nice to see. Something else that is nice to see is the fact that they do raise the dividend every single year, or at least it seems like every single year they are raising it. And of course they're raising it, as we can see here, at first by a half a cent. They went down to 9 cents for 1 quarter, and then it's gone up to 10 cents, and then it went up to 12 cents, and now down to 11. And then it blew up to 12 cents, and it's been sitting at 12 cents ever since. Isn't it funny how since the word, isn't that kind of funny? Since. Its top holdings are Procter & Gamble, Nestle, Coca-Cola, PepsiCo, Unilever, Philip Morris International, Diageo, CVS, Atria, and British American Tobacco. This is the only downfall to this ETF is British American Tobacco. I personally don't feel like this is the type of stock to hold into the future, considering that there is a lot of activists going up against tobacco. Also, Coca-Cola and PepsiCo are not necessarily healthy, neither is Nestle. To be honest with you, it's not very healthy, and there may be some different regulations coming out about sugars and things like that into the future. So definitely there is some risk to this ETF. However, at the same time, there are a lot of healthy choices that Coca-Cola, Pepsi, and Nestle have all brought out. We have to remember that Nestle has a huge, massive bottled water company, and Coca-Cola is really bringing out a lot of different healthy options as well as energy drinks, and same as Pepsi. If we look at Procter & Gamble, which is one of the top companies in this ETF, we can see that it does pay a 2.5% dividend. Its 5-year chart is really, really amazing, especially when you consider that there was this big hiccup when it comes to the COVID disaster. It didn't drop massively like the rest of the market. It only dropped roughly about 16, 17, 18%. And then it recovered better than before. The only interesting part is it did have that double top, which did have that downturn, but it is starting to come back up, and it looks like a possible upside down head and shoulders depending on at least the type of chart that we're looking at. This chart doesn't necessarily show it, but we do see on a younger chart that it does tend to go like this, which means that there should be upswing coming right now. If we look at Coca-Cola, which is another one of the bigger holdings in this ETF, we can see that they do pay a 3% dividend and also trades at a very high volume. We can also look at different things like the PE ratio being in the 30s, which could be classified as high to some investors. And its chart hasn't fully recovered as of yet when it comes to the COVID disaster that hit. That's actually quite interesting to me, maybe because I was thinking that there was a lot more people buying things like Coca-Cola for staying at home and stocking up, but I was wrong. Maybe it's still lower, mainly because people are not going to work. However, if we look at this chart, it does look like there may be a possible massive upswing coming very soon. I hope that this video has helped you understand this ETF. If it has, hit that like button and subscribe. Of course, never listen to a random dude on the internet. Do your own research, do your own homework. Make sure to go check out the investing books down in the description. They're my favorites, and I'll see you guys again next time.